Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, August 19th, 2024. So, in terms of economic news last week, it was a big news flow week, mostly regarding inflation. We'll go through three of the major metrics. And in total, I would say the macroeconomic data that was released last week was good, with inflation rates actually falling further and actual signs of consumer spending holding up really well. So we go back to last Tuesday, we had the PPI Producer Price Index month over month. That was expected to come in at a 0.2% increase, came in at flat, 0.0. So good for input inflation expectations going forward. The next day, we had the inflation rate, the core inflation rate, CPI, and CPI headline, and both of those came in exactly as expected, a positive 0.2% month over month. So between those three metrics, I would say the inflation news last week, obviously pretty good. Then we move on to Thursday, retail sales. So retail sales were expected for the month of August or for the month of July to be up 0.3%, actually a full 1.0% month over month. So there's been a lot of discussion about whether or not the consumer is tapped out at this point. This would suggest, at least through July, that is not the case. So also on Thursday last week, we had initial jobless claims. That has been elevated. That's something we're watching much more closely now. So the consensus for the prior week was 235 in terms of initial claims, came in better than expected at 227,000. So Friday, we had some housing data, building permits, housing starts. Both of those metrics slightly worse than expected, but not, I don't think, a big deal. I don't think investors are terribly focused on that right now. The other data point that came from Friday was the University of Michigan Consumer Sentiment Survey, the preliminary. That was expected to come in at 66.9, actually came in just slightly better at 67.8. In terms of the economy and how it's doing, let's take a look at the Atlanta Federal Reserve, their Fed now, and what they expect. The prior week, we had mentioned they had expected very strong growth here in the third quarter. U.S. GDP expected to grow 2.9. Well, they cut that expectation last week to 2.0. They don't cite the factors. Usually you have to kind of connect the dots yourself, but it looked like a pretty big drop without really any related information that would suggest it should fall that much. But nonetheless, Atlanta Federal Reserve still expects 2.0 GDP growth here in the third quarter, which would be very strong following a 2.8 from the second quarter. Inflation expectations. Again, the inflation news last week I think was pretty good. So inflation expectations dropped a little further to 2.08%. So over the next 10 years, that is the expectation of average inflation rate, 2.0 to 8, which is really good. Would be really good if we could hit that. So what did this news do to the expectation of what the Federal Reserve will do during the September 18th meeting? Well, it actually lowered expectations for rate cuts. So prior week, the expectation was for that September meeting, in terms of 2 cuts, 50% expectation that we would actually get 2 cuts, so split right down the middle for September. That's come off significantly over the last week. So now the expectation built into the Fed funds future market is there's a 26.5% probability of 2 rate cuts. So pretty likely at this point we will see only 1 rate cut during the September meeting. When we take a look at the end of the year for December and take a look at the embedded expectations, the expectation of at least 4 rate cuts was 74% a week ago. That dropped to under 62% as of the end of last week. So both near term and now through December, expectation for Fed cuts have been pulled back a little bit. So let's take a look at how the markets responded to this news here in the U.S. And as you might guess or might recall, very strong equity markets in the U.S. S&P 500 up nearly 4% for the week. S&P 500 now, year-to-date, up 17.5%. You just look through all the indexes here in the U.S., up strongly. NASDAQ last week up 5.3%, leading it. Russell 2000 lagged. However, it was still up 3%. So in terms of international markets, not up quite as strong as U.S., but also a very strong performance. So the MSCI World ex-U.S. Developed Market ex-U.S. was up nearly 4%, so just behind the S&P 500 at a positive 3.94%. And then the MSCI Emerging Market Index up 2.8%. So again, year-to-date, S&P 500 leading, up 17.5%, NASDAQ pretty close to that. But that compares to the MSCI World ex-US up 16.2%, and emerging markets up 6.8%. So fixed income here in the U.S., another strong week. We had the two-year yield didn't move at all, but the 10-year did drop 6 basis points. So the Bloomberg U.S. Aggregate Bond Index was up 53 basis points last week. So now on a year-to-date, bonds solidly up, positive 2.91%. So let's take a look at the economic news coming out this week. It is a very light week, but with one potential wild card that could change markets or impact markets significantly. So we have initial jobless claims coming out on Thursday, existing home sales. Initial jobless claims could move the needle a little bit. It was 227 this last week that we mentioned. Expectation is 230. But the big item that could move the markets is the Jackson Hole Symposium, which Fed Chair Powell will be speaking at. So before the September meeting, we're going to get some clue as to how the Fed is feeling about up-to-date economic information, which we mentioned again on the inflation side has been really good, and it still appears that we have solid growth. So the expectation for 2 interest rate cuts has been reduced for that September meeting, but we'll see what Powell has to say, and again, it could impact the markets one way or the other. Lastly, on Friday of this week, we'll see new home sales. That was 617,000 month of June, expected to be up a little bit. And then building permits for July prior was 1,454,000. That's expected to be down a little bit. Again, we share with you these real estate numbers, related numbers. They really have not moved the markets much, so we're not going to spend a lot of time discussing them. So that's it in terms of the economic activity from last week, from this week, and how the markets responded last week. So we just thank you for your attendance, and we'll look forward to seeing you next week. Thank you.